Welcome to Global Mantra Market Outlook 2015 with me, Tanvir Gill. This is a special series that we bring to you each year out of the City of London, speaking to prominent fund managers and market speakers and getting their outlook for the new year. My guest today on the show is a market veteran, Russell Napier. Needs no introduction. He's an independent strategist at Eric. Russell, it's great to have you on the show. Thanks very much for taking out the time. Let's start by analyzing a recent comment of yours. Sometime around mid-October, you said in the market sell-off that the veil has been lifted. What is it that you're seeing behind the veil?
Well, behind the veil, there is what a market looks like when it's not manipulated. And that's really what we're talking about here. I think few people would quibble with the fact that the markets are being manipulated, particularly by the central bankers. So 6-7 months ago, a client said to me, what is this market we have? There's no volatility, there's no volume, and prices rise steadily. Have we ever seen that before in financial history? And the answer is yes, in the Soviet Union. Because if you and I are in the market, but there's a third party who's likely to turn up at any stage and tell us what the price is likely to be, well, we kind of sit around all day waiting for that person to turn up. That's the market we live in. But on that particular day in October, in that particular morning, in that half-hour stretch, huge volumes went through in the Treasury market. Now, the number one asset class that's being manipulated is the Treasury market, and all things flow through that. And what we saw was a sudden rapid decline in yields, a sudden rapid pricing out of deflation. So what I'm saying is, behind the veil, when you strip away the activities of the central banker, there's a natural market force wishing to deflate. Now, the central bankers, of course, have spent 5.5 years desperately trying to stop those powers of deflation. But 5.5 years later, the minute they step away from the market, they're still there. Now, I've had a view for 3 years that actually those powers of deflation would win. They would overcome central bankers. We saw a little snippet of it there, and I think there's more of it to come this year and next year, and that's probably going to be manifested primarily through a strong dollar. And that's how the veil is lifted going forward. Not so much in the United States, but lifted in the rest of the world. And a strong dollar is going to be a key catalyst to show us these forces.
Sure, but why not the United States? What's the view there? Because now QE has ended in the US, and one is adjusting to a post-QE environment. How do you think the US would adjust to it? Because, it's measured over a longer period of time. You've just seen about a month or so go by. How do you see the road ahead for the US?
Well, the interesting thing is you'd expect bond yields perhaps to be going up, but they're not. And this has been the pattern in the past when the Fed has stopped QE, which it has done in the past. Bond yields tend to go down. That's back to this point. The natural reaction is for the world to deflate. The reason that I'm not, I think inflation in the United States is going down. Real rates of interest are going up. That's not good for the US economic activity. But when you get a strong dollar, actually it puts the really rapid changes in the world onto somebody else, and those people who are linked to the dollar. So I'm still of the same view that in the United States of America it will also have another bout of deflation. But I see the real pressure for that coming from pain outside the United States, particularly in emerging markets, particularly in China, even through lower yen dollar selling prices from Japan. It's coming to the United States, but I think it's the dynamics building out there, lower commodity prices, higher dollars, suggest it's going to start somewhere else.
Since you specifically mentioned that you're more worried about the outside world, outside of the United States than the US, I wanted to get a sense of what's your view on the US from a 6 to 8 month perspective, because all eyes will be on the Fed on when they actually move up on rates.
Well, my view is that they won't move up on rates, that they'll be back with more quantitative easing, because the implications
So we'll have a QE4?
I suspect we'll have QE4. I don't think the economy is robust as we think it is, and when it gets hit by these external headwinds, then it could come off quite sharply. There are people who think that actually what will happen is if we import deflation to America, it'll have a disinflationary boom that will encourage more consumption, maybe a little bit like the late 1990s. My view is very different. I think if real rates of interest go up, then economic growth is probably going to slow. Inflation comes down, nominal rates don't come down, real rates are going up. That's not what happened in the late 1990s. The Fed was able to cut nominal rates. I think fundamentally the baby boom generation is a completely different place and doesn't necessarily respond to the lower price of goods by consuming more. So I'm not optimistic on the United States. But as I said, deflation in the modern era is not like the 19th century. It isn't really based upon the overproduction of goods and the underconsumption of goods. It tends to be a slow process towards zero when suddenly there's a financial crisis. Something breaks, something shatters in the system. This is exactly what we saw in late 2008, and that occasion driven by the deflation in US residential property prices. I think the dollar drives that somewhere else, and there is an incident, an event at which credit freezes again, and that's the real rapid deflationary force. And there's no part of the world, as we saw in 2008, which is immune to that form of deflation, because it's a credit deflation, it's a debt deflation, it's the most frightening type of deflation. It seems unlikely, given the robustness of the US financial system, that it begins there.
Okay, if that's your view, I just want to understand that what would trigger what would trigger perhaps Europe, emerging markets, or the rest of the world outside of the US to step into that zone, into a strong deflationary environment?
Okay, I can give you a specific set of things that could happen that would suddenly have it right in the front of people and people thinking about it. A dramatic decline in the yen is one, because that would instantly produce Japan selling things cheaper in dollar terms. And eventually Japan might generate some inflation, and eventually it might inflate away some of those competitiveness gains. But in the early stages of this, Japan will be selling things cheaper, and that's deflation. The impact for the rest of the world is probably not just the first order impact. The second order impact is probably worse. It would undermine the competitive position of its competitors. And therefore, say a country like Japan or like China, I think would find itself under extreme pressure on its exchange rate if the yen falls to 130, 140, 150. So in a world where the yen's at 150, I don't think we'll be having conversations of what does that mean for Japan, because it's quite obvious what it means for Japan. The whole focus will be on China. Is China going to have to respond with a lower exchange rate? So a Chinese lower exchange rate is another one. And third, the one that will always get you there is a major failure of a financial institution or a country. So when you have a piece of the credit system which defaults, or is likely to default, then you suddenly get a seizure of credit. Now, in recent history, that was Lehman Brothers, that was a financial institution. If we go back to 1998, it was Russia. If we go back to 1982, it was Mexico. So for me, it's much more likely now to be
which region or institute looks
well, for me, it's
vulnerable?
Eastern Europe and Turkey, that these are the most vulnerable countries in the system. The real vulnerability is of someone who borrows in one currency to invest in another currency. That doesn't happen in the United Kingdom, the United States and France. People tend to borrow in their own currencies. But in the emerging markets, they tend to borrow in somebody else's. Now, the whole of Eastern Europe and Turkey, and to some extent South Africa, have borrowed so much money in somebody else's currency that it actually makes it probable that there's going to be a significant default somewhere in that region.
But would that happen in 2015? Is the risk of that higher in 2015, or do you think that's a story 12 to 18 months down the line?
Very hard to say. I can't remember our exact conversation last year, but I suspect I was talking about Turkey. I mean, Turkey is the one that just keeps standing out. It's borrowed a huge amount in somebody else's currency. It's got a huge current account deficit. Somehow, somewhere, it is accessing capital to come in and hold the whole thing together. But what we've found with this in the past, with emerging markets, particularly in the Asian crisis, is that emerging markets can access all the capital in the world until the day they can't. Now, if you'd asked me this time last year, I'd say Turkey wouldn't be able to do it for another 12 months. So it's done it for another 12 months. Can it do it for another 12 months? Well, I don't think it can.
Okay, so you think that there is a risk of a default in Eastern Europe, especially Turkey?
Yeah, well, some of the countries, particularly Poland and Czech Republic, are already falling into very mild deflation, but it is a very mild deflation. Now, you have no monetary response to that. If you're shadowing the euro, you have no monetary response to that. And the question is always, how robust is your financial system? And socially, how robust is society in a deflationary period? And every society and every financial system is more or less robust, depending on where it is. So we might, when would it happen that Poland had significant deflation that threatens the stability of its banking system, social unrest? Don't know. But the process has begun. And the thing is, it accelerates very quickly if capital doesn't come in. So if we look back to the Asian crisis, by the end, everybody knew Thailand was going to devalue, but everybody thought the other exchange rates were fine. And what happened when Thailand devalued, nobody could get any capital, and therefore they were all instantly under pressure. So there is really, I believe, particularly because of the strong dollar, a significant event that if one emerging market goes, suddenly we stop capital flowing to all the emerging markets, and all of them find themselves with lesser or greater problems. I'm not for an instant saying that we have bankruptcy in all the emerging markets. The pressure, I think, falls squarely on Eastern Europe.
But at what stage would that happen? Because the markets have been continuously drawing support and encouragement from successive QEs. At what point does the market say, this we've dealt with QE, it's not working, the underlying fundamentals of the economy are not changing, it's not healing, so this is a short reason that the market should sell off? When would that happen, and would that be a 2015 story?
Yeah, I think there's a 2015 story because it's based on the dollar, and the dollar's already been a 2014 story. So what we need to understand is the thing that's different in this scenario is that easy monetary policy is now driven outside of the United States. There's going to be levels of aggressiveness of central banking, and even though I think the Fed might be back, I would agree with you that the Europeans and the Japanese are likely to be more aggressive. Now what that has is a dollar going up, and that puts extreme pressure on everybody who's linked to the United States dollar. So we can say, well, monetary policy will solve that, monetary policy will solve that, but how on earth do you bring the dollar down in a world where US rates are close to zero, where 5.5 years of quantitative easing didn't bring it down, it actually went up, where the Europeans and the Japanese are doing what you just said they do? There's intense pressure on China. So, going back to where we began this conversation, there is a deflation shock out there, but it's coming from emerging markets. Now, let me tell you how important they have been. Over the last 5.5 years of quantitative easing, 80% of the growth in the global money supply has been in emerging markets. The only reason the world is not deflating today is nothing to do with American demand. It's to do with Chinese demand and, to some extent, Indian demand. And that's how we got out of the deflationary trap back end. Now, if that's the bit that's in trouble, if that's the bit that's under pressure, then if that bit begins to fall apart because the dollar's going up, then I'm afraid it really doesn't matter that you're running this easy monetary policy. So the question will be asked, what good does easier monetary policy bring to us, or an attempt at easier monetary policy in Europe and Japan, if the dollar's going up and it's putting extreme tightness of monetary policy on emerging markets? Net, this is tighter monetary policy, not easier monetary policy.
So, side of deflation, you're wary of a big dollar rally in 2015?
Yeah,
could it push the dollar index to 95, to higher levels? I mean, is that the kind of level that you
Well,
see?
yes, because this is so forecasting.
You have a target?
Well, I don't have a
index.
target. It's best not to have targets, by the way. Just directions is difficult enough in our business.
Yeah.
And you can make money.
But it's been a strong rally for the dollar this year.
Sure, but so this is why the dollar is different. Forecasting currency is incredibly difficult. But every now and then there comes a place where it becomes much more inevitable, and that is when you have a forced buyer. So anybody who's ever been in the market can smell a forced buyer or a forced seller. There's a certain smell in the market when it happens. Now, it happens on the dollar in extreme circumstances because so many people borrow in the dollar to fund in another currency. And if the dollar keeps going up, at some stage you have to cover, and that makes you a forced buyer. And of course, as you start to be a forced buyer, you tend to push it higher. So we have seen this at least 3 times in the last 30 years, and that's why I think it could happen again. So that's where the dollar can keep going.
Maybe not in terms of a target, but what would be a level which would make you uncomfortable?
I'm already uncomfortable. I mean,
okay.
I'm actually very surprised as to how far the dollar has gone without creating more distress in emerging markets. No, it's created I wouldn't call it distress.
But is the dollar rally more to do with the rate differential in anticipation that rates will go up, or just the fact that US is the sweet spot right now? So fundamentals are improving. So better park. Or is it just a broad safe haven trade as well? Given that there's uncertainty in Europe, there's a bit of uncertainty in Japan with the recent numbers signaling a recession. And emerging markets, in anticipation of the rate hikes in the US, might be a bit volatile. Well, so which of the 3 reasons?
Well, we're in a very strange world for the dollar, because I was at a presentation a few days ago by a friend of mine who had 150 charts. 150 of them were bullish for the dollar. Now, that's not a normal world. In a normal world, if you were bullish on an instrument, maybe half of those, slightly more than half would be bullish, but there'd always been some bearish reasons. And we really are beginning to step into a world where you say, what is bearish for the dollar? And the stars seem to be aligning. Now, that's usually a warning sign of some sort, but all the things you say are true, and I can give you half a dozen other ones that suggest the dollar is going to go up. The Fed has tried to do something about this in the past. So in '82, they definitely took action to bring the dollar down because of what it was doing to EM. In '98, there was something similar because of Russia and the connection to LTCM. In 2008, there was definitely something similar going on. But remember, nominal rates were much higher. So the easy and simplest thing you can do is cut rates. Remember, the Americans formed a committee to save the world. The 3 smartest men on the planet. They decided to cut interest rates. Well, I didn't have to be that clever to decide that cutting interest rates. Well, you can't do it this time. So the real interesting question is, after 5.5 years of QE, interest rates close to zero, what can they do to stop it?
a stronger dollar would mean, of course, pressure on emerging market currencies. Could it pose a threat to EM currencies the way we saw in the Asian crisis in the late 90s? Are we on the brink, or at least is it sensible to talk about such a strong devaluation in EM currencies, a currency war sort of being triggered?
Yeah, well, the currency war is well underway and Japan's winning. That's the first thing to say. We've talked of currency wars for 5 years. Now there's a winner, and the winner is Japan. Now we just have to work out what the implications of the currency war are finally, now that somebody has won it. And you fight a war to win. What are they fighting to win? They're fighting to win external competitiveness. And they're gaining that from everybody, including emerging markets. So the pressure is on. And in the Asian crisis, the same thing happened. People have forgotten that the yen went from 100, I think, to 148 in the space of the Asian economic crisis. It was passing that pressure onto the emerging markets. But there's one crucial difference with 98, and that is the level of foreign currency debt to GDP. When it's at a very high level, you simply can't let your exchange rate go, or you go bankrupt. Now, I would argue that probably everywhere in Asia can let its exchange rate go because they don't have an excessively high level of foreign currency debt. I would also argue that's true for Latin America, but the one area where it's definitely not true is Eastern Europe, Turkey, and South Africa. So I keep coming back to those ones because everybody else has an option, which is devalue. That's a deflationary option, by the way, for everybody else. But at least it's an option. And when you've got far too much foreign currency debt, you've painted yourself into a corner, which is where they were in 98, but not where they are today in Asia.
So given the pressure that you expect to see on EM currencies and currencies outside of the dollar, are there spots where your conviction would still hold? Because I think about this environment and I feel that perhaps countries like India will stand out, even if the world is plagued by deflation or a stronger dollar, given just the domestic fundamentals and the reform story there.
Yeah. Absolutely. I mean, from a macro perspective, India has been in a better position for really quite some time. And the people of India owe a great debt to its central bank for that as well, because they are a central bank who, on the whole, tended to stand away from the exchange rate. The temptation is always there to manipulate an exchange rate and believe that that's a free lunch, and it isn't a free lunch. And because you've always had more flexibility in the exchange rate, that's stopped too many people borrowing dollars. We all know that some people have, but it's barred too many people from borrowing dollars, and therefore leaves the currency flexibility there so that India can move forward by letting the exchange rate come down. And now in a deflationary world, that's actually easier, because we know that one of the real reasons that India wouldn't be that keen on a weak exchange rate is because of the inflation that would come through, particularly food inflation that would come through. So deflationary world is, if you had to be somewhere, it's better to be in India. But I want to stress, as I did last year, that this is macroeconomics. It doesn't necessarily have anything to do with the stock market. There isn't any great link, long run, between the stock market and macroeconomics. Now, if the stock market was cheap at this time, this would be a wonderful time to buy Indian equities from a relative perspective and even potentially from an absolute perspective. But the market is really very expensive.
16, 17 times, many would say that the Indian market is fairly valued. So how do you rationalize that? Because at the peak of the crisis, the trade was at about 21, 22 times. So we have some headroom from here.
Yeah, there's a lot worse markets. There's a lot more overvalued markets than India, but it's in no say it's cheap. I mean, the problem, there's a difference between what institutional investors do and private investors do. And institutional investors have got the curse of always having to do something, and therefore India doesn't look particularly expensive on that basis. However, if you're a long-run investor, India has been a lot cheaper than this, and at some stage will be cheaper again. And if you're a private individual, you should just be waiting. There's no downside for a private individual to wait until markets get cheap, and those opportunities may come only once 6 or 7 years, but they're incredibly profitable opportunities when they come.
So then what would you buy in 2015 from, as an asset class?
I wouldn't recommend owning equities, full stop, if you don't have to own them. And that includes American equities. If you think that you can own cash and wait and take that opportunity, then you should do so. And gold, I mean, gold is not a thing you want to own in an era of deflation, which, so I've not been that keen on gold for a few years because I changed my mind and thought it was going to be inflation, that's gold, deflation, that's not gold. But so
higher cash levels is what you recommend?
Absolutely higher cash levels, and you've got to be very clear where you keep those higher cash levels. I've always suggested that keeping them in Singapore was a better place to keep them. Just on the gold issue, it's really very important. In a deflationary environment with rising real interest rates and a strong dollar, the gold price should come down. But, and this is the crucial thing about gold, at some stage the next reaction that we have from policymakers will not be a monetary reaction. If monetary policy fails, what do? More of the same? To do the same thing over again and expect a different result is a sign of madness. So it'll be much more aggressive government intervention in all sorts of things, maybe even potentially exchange controls. And that's when gold will start to perform, when people begin to realize that government manipulation of private wealth is the next thing onto the agenda. That's when gold goes up, but not before that. It's difficult to know when that might happen.
So then what would you buy in 2015?
Well, just own lots of cash. I own Japanese equities, by the way, hedged back into the dollar. I think the Japanese are trapped, effectively trapped. This is a trap we've seen throughout the 20th century. The only possible buyer now of JGBs is the central bank.
Do you own Indian equities?
I don't.
Okay.
I haven't, because they're too expensive. You know, so I get paid to
Chinese
make these.
equities?
No, definitely not, because they're not companies.
Okay.
You know, I get paid to make macro comments, but fundamentally it's about buying things when they're cheap, and buying things that are real companies, where you get a share in the economic interest created by the company. And I would say that most Chinese companies are not there. There are clearly exceptions. I don't doubt that whatsoever. But most Chinese companies are not actually companies. Now, India's better, and India's different. But
so would India continue to draw more capital in emerging markets,
yes,
just given
it
on a relative basis?
And obviously because of the election as well. It's clearly going to, I think, very clearly going to tend to draw more capital. And I think to some extent it's suffered from being in this comparison with China, which is kind of a silly comparison. But the more that we see that China has issues with its stability of its financial system, the efficient allocation of capital, whether the corporations are actually working for you or against you, then, you know, and whether they can make a transition to a consumer society when India's already slightly moving in that direction. India's got a reasonable number of private sector banks. So the comparisons become, you know, I've been making these comparisons for many years, but they're becoming more favorable by the day as people realize that being involved in the rump of the command economy, which is what China is, may not be a good place to be, because that rump will have to change at some stage, and it's difficult to see how it changes. Not impossible, but difficult to see how it changes in a positive way for investors.
Okay, final question to you then. I mean, map 2015 for us on a quarter basis. I know it's very hard for you, and you know you take long-term macro calls, but how do you see 2015 progressing, given the event in expected rate hikes in the US, as also low inflation prints in Europe, which of course you know, coincide with perhaps a stronger dollar rally that we could see? How do you map what happens time-wise over 2015?
Well, this will all start with the yen and the dollar. That's the crux. That's probably the most forecastable thing we can do. So let's take them in series and when things might happen as the yen begins to go down and the dollar might begin to go up. So as I said, the pressure is on emerging market, but the big one that people will begin to focus on, and given how far the dollar has already come, this could begin to happen in the first half of next year. You could begin to see a real focus on the RMB. People will say, can this country print enough money to grow, reflate, create inflation when it's pegged to a very, very strong United States dollar? And the further the yen goes, the more the focus shifts from Japan. And I think it's fairly predictable what happens in Japan as the yen goes down, to China. Now, what that means for the world is I think it will stop flows of capital sometime in the middle of the year to the second half of the year into emerging markets. So I'd be very surprised if the movement in the yen-dollar rate through the prism of China didn't create some sort of major emerging market crisis by the middle of the year.
So you're saying second half of 2015 would be really tough for emerging markets?
Yes, and depending on how quickly the dollar goes up and the yen goes down, it could happen before that. But that's the key driver now, that's the key catalyst. We always, if there's a bubble, and I think there's a bubble, particularly in emerging market debt, you have to look for the weak bit. Where's the weak bit? A bubble bursts at its weakest bit. It doesn't burst at its strongest bit. And the weakest bit is people who borrow in one currency to invest in another currency. And the dollar has always been the thing that pricks that bubble. And, you know, it's in Eastern Europe, but China has been borrowing a lot of dollars very rapidly. If China was to stop borrowing dollars or be shut out of the dollar market because the dollar is going up very rapidly, it comes very quickly to China. And believe me, I think everybody who's watching would agree with this. If it comes quickly to China, it comes quickly to the world these days, because that has been the source of so much of the world's money growth and inflation growth over the past 6 years.
Well, that's quite interesting. Let's see what happens then. Thanks very much, Russell, for taking out the time and speaking with us today. With that, we come to the end of this edition of Global Mantra Market Outlook 2015, with the promise that we'll come back with another special guest next week. Till then, take care.
I think India, given the changes that are outlined earlier, new government, a credible central bank, compression in the current account deficit, I think India stands a very good chance to go against the trend, even if there is a general outflow of capital from emerging markets. But it really depends on what is the driver for the dollar strength. If it is higher interest rates in the US, significantly higher interest rates, then I think everybody gets hurt, including India. India to a lesser extent. But if the dollar strength is rather due to growth differentials between the US and some other parts of the developed world, then I think it's a different story.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.